Thank you so much. What I'll do, I'll focus on a small piece of information regarding the role of fund managers as far as deepening the fixed income market is concerned. But before I do that, maybe just a bit of introduction. My name, as said, Paul Gishero. I think that second name is said differently by different people, but the Kenyan way is Paul Gishero. I'm working at NCBA Investment Bank and privileged to actually be performing the role of a Chief Investment Officer in our fund management division, or a division we call wealth management. So the conversation I want us to have today is really the opportunities and how we see this whole space playing, and the excitement that for some of us in fund management have to hear that Ethiopia is eventually getting a stock exchange. Because for someone playing in my space, this means more and more opportunities. And I want to believe that by the time we're done with this conversation, all of us will see the resultant opportunities by what's happening in this market. So maybe to start is to ask all of us whether, and this is introspection, what we understand by the role of a fund manager, whether a fund manager means the same thing to all of us. In my life, a fund manager meant someone was given money by donors to manage. And the idea was you get $100 million, disburse that money and account to the donor. That is one definition of a fund manager. But the definition I want to focus on here is to focus on the fiduciary role, or the role of trust that is entrusted to someone. In this case, you have your money and you want to look for someone to take care of that money. And the reason we are doing this is, as you can imagine, Ivan has given us a very good presentation. Can you imagine that last person on the street trying to understand some of these concepts? You end up losing, a good chunk of people, and they may never get a chance to actually appreciate what these investment solutions are that ESX is bringing about. Tell someone on the street that you need to look at the duration before you buy a bond. I mean, they can't even tell what exactly you're talking about. You need to look at the yield. What exactly are those things? So what a fund manager does in the market is to take care of the interest of those investors by creating that link that they need to the market. I have my money, I don't know how to invest it, I entrust a fund manager to actually do that for me. And that can happen at very, very, very many different levels. And with that, just to highlight, for example, what we are doing at NCBA, I've just put four bits there to just illustrate what, for example, fund managers do to help the market. And I hope with this we can start illustrating what opportunities are there for us as business practitioners to actually take advantage of the development that's coming into this market. So at the first, what do you call a six-sided shape? Thank you for those who remember. I would never have described it. I was about to say Pentagon, but then I remembered I'm heading to the US in that case. So I would ignore. So the first sector, there's something called unit trust funds. And elsewhere, these are called mutual funds. Elsewhere, these are called collective investment schemes. So what happens in the market? If you go to, for example, to the rural Ethiopia, there are so many people who may have some bit of money that they can invest, but because of the way the market is structured, those people cannot access the market. They may want, for example, when Ethiopia eventually launches a fluid treasury bill market, a fluid bond market, they may actually want to get to that market. But unfortunately, because of limitations, they are not able to. If I give an example, for example, from my own country, if I want to buy a treasury bill in Kenya, I need, let me just say it in Kenya shillings, I need 100,000 Kenya shillings. And for simplicity, I'll say $1,000, just using the old we used to divide everything by 100, and it was very easy that way. I need $1,000. If I need to buy a treasury bond, I need, what is half of that? I need $500, for example. Now, not every person can afford to have that money readily. And so these people, unfortunately, for major reasons, are not able to access these markets. The other way, you look at it, even for us in this room, if you're salaried, the way your money comes, it comes in bits. And when it comes, I'm paid 100. By the time I know what to save, I've lost 70 and I'm left with that. I can't access the market that readily because of the quantum of money that I'm having. So what is happening with unit trust funds? They actually allow the unitization of some of these investments that governments are issuing, so that if the government has issued treasury bills of whatever quantums, and the minimum investment is 100,000, all I'm telling you is that all of us in this table, can we put our money together and we all access the market, and we're able to start buying some of these investments that could not be accessible. Now, the person who has the least amount of money, unfortunately, is always at disadvantage, because think about it. If they come to your bank and ask for a deposit, if you come with 1,000 bar, is it bar or bill? Bar, then you probably don't even getting a deposit investment. So unit trust funds come to, or collective collective investment schemes come to help these people come together and as an investment group, then are able to get exposure to some of these investments. Now, those roles are performed by fund managers. So you can see almost a low-hanging fruit here that as soon as this market is launched, you can actually set up a potential fund management business that start putting all these people together. I mean, you have a good, decent population of 120 million people, whatever that number, I could be very wrong, but can we start thinking about the opportunity that result to actually bring these people to the market? And what that does is then it gives you a very good chance to deepen the market and as fast as possible and make sure that everyone is accessing these opportunities. The second section here, private institutional wealth, this focuses on what you call the more high value customers or high net worth investors. This is someone who can afford to invest in large quantums, but for one reason or another, they are too busy even to focus on the market. Or whatever their space in life, thinking about duration, thinking about coupons and all those things is not the last thing they're thinking about. So what you do as well is you can actually create managed investments on behalf of these people. And the underlying investments that you're putting in their portfolios will be these bonds that will be issued, will be these treasury bills, and whatever other available investments will be coming about. And then there's, of course, the retirement benefits management. Retirement benefits here is all of us one day, and it happens so fast, shall retire from 8 to 5. We shall need to have parked some money somewhere. That money needs to be invested prudently. So mostly by regulation, you are required to put that through a fund manager as an institutional investment manager. That person or that institution by law is required to manage that prudent to ensure as much as possible, but that by the time you get to retirement, then you actually have a safety net that will take you to retirement and can replace some of the income you'll have lost in the process of employment. And then you'll have some other people who may have the information, but they just want to take the risk. They just want someone to take them to the market. Even here, he's probably very busy doing what he does every day, but you just need someone to actually facilitate you in taking these transactions to the market. I want to buy 10 million of a bond. Can I get someone to facilitate me to do that? So that is what we call execution, and it can be done for example, a securities broker level. It can be done at a fund manager level. Now, when you look at all these, for me, this is an opportunity as far as business is concerned, because as a business, for us, we are actually earning substantial or meaningful management fees for doing this kind of business. So it behoves on all of us then to start seeing the opportunity that's likely to result as this market rolls out, so that we can, we can also amplify the kind of returns that we are getting from our businesses. You'll see me skipping very fast through some of these slides, because what I want us to focus on is really what roles that we are really doing in this market and in deepening the market as fund managers. So I gave an example of someone wants to access the bond market, but because of quantum, they cannot access the market. I gave an example of someone who don't have the space in terms of knowledge and experience to actually access this market. So what does the fund manager actually do? The fund manager plays a very important role for the market in terms of what we call intermediation, which is what I've said. Because at some point, you actually want to take a transaction in the market, but you don't have either the right quantum or the right route to actually take that transaction in the market. We also play the role of what we call aggregation. Aggregation means, as I was talking about earlier, small amounts, put them together and take that transaction to the market. And what that does is you really work on creating some kind of trading opportunities, growth in the secondary market of the market, so that once the government issues, for example, whatever securities they issue, once a corporate issues securities, then those securities can actually be fairly liquid through capacity to actually trade them in an open market. Those are some of the roles that fund managers are doing, and really helping the market to grow deeper and deeper. But for this to actually happen, there are processes that goes into it, there are expectations that we have as a market. So what you're looking at for a potential deepening of the fund management industry is actually having diversity in terms of investors. And this is something that the market always looks for. So if I give an example, for example, in the Kenyan market, our market is dominated by banks. The second players in our market is pension funds. The third level of players could be insurance companies, and then the rest of us in that lower category. Now, the only challenge you have with that kind of a market is banks will invest for a particular objective. And unfortunately, most of those objectives are very homogeneous. So that banks are either investing for liquidity or to diversify their lending risk and all that. So for example, sometimes I see, and I think it's a reality of the current times that we are living, banks are all investing in short-term securities just because of how the markets are looking. So what you end up with is that if there's anything long-term, there's no meaningful market as far as that section is concerned, because everyone is looking at the same kind of securities. Pension funds, on the other hand, should be investing in the long term, but because of how fund managers at times are evaluated for their performance, they have also moved the short-term market so that everyone is actually focusing on the same market. Insurance companies should be long-term, especially depending on the kind of business that you're managing, as far as an insurance company, but also those, because of the challenges you're having, fall back to the short-term market. Now, that homogeneity or equal, similar approach across all investors really challenges, the growth in the market. So then the most ideal situation a market can actually be in is in a place where you are able, as much as possible, to diversify the kind of investors. And that's how you see for us, then you're saying, if I can bring in the so-called collective investment schemes, where the investment approach could be different. If I can bring in high net worth investors, whose approach could be different. If I can bring all these different types of investors, then you're actually increasing diversity and different kind of opinions as far as approaching the market is concerned. So that we are not all moving as one heart. And you also get opportunities that create liquidity when you want, return investment when you want, and all that. Then market needs the right kind of, regulatory environment. And I think that for Michael is certainly something that, that I'm sure you're working well. And the idea here is to make sure that if I get into a trade, that trade will be completed without any hitches. And I think one thing that I really would say I like about the Kenyan market, in terms of the settlement process or trade completeness, that is working very well. In my many years of practice, I don't think I've had a chance where, a situation where, for example, settlement did not work. Fund managers are really looking for that to make sure that as you entrust me with your money, that I'm very sure capacity to complete transactions is even easier to deliver. And then, of course, the concern of efficiency. Efficiency here means what is the transactional cost that I have to bear? What is the market impact that I have to bear every time I'm doing a trade in the market? So that if it's too expensive to buy a bond, if it's too complicated to buy a treasury bill, that investment becomes useless in a big way. I need easy to access investments, accessible in quantums that make sense to me. The cost and process should actually make sense. Otherwise, some of the reasons that some of our markets are not developing that fast, it is that friction that sits within the process so that you're not able to come in and out. And I know a lot of African markets are struggling with that to some extent in terms of the fluidity and the cost efficiency as far as the market is concerned. So those are things that I truly believe, because as we said, Ethiopia is in a privileged position, can actually be dealt at the early stage as you develop the market. So how is a fund manager business organized, or how do fund managers organize themselves? Remember, what a fund manager does is a position of trust. I bring this in the conversation about fixed income because, taking an example, I think taking Kenyan market, for example, any portfolio that you are building in the Kenyan market is probably upwards of 60-80% in the fixed income market. So the dependability, the reliability of the fixed income market becomes very important. But the decision as to what the fund manager wants to invest in is actually what the process, what is driven by the process. What am I saying here? So you come in and trust me and tell me, Paul, I want you to manage my investment, and all I need for you is the next 10 years deliver a return of X%. So what I'll have to do is to actually think about what ropes or what role I actually play to actually make sure I can deliver that 10%. So it starts by one, I need to analyze the market and understand where the market is. I need to analyze the opportunities and just figure out what opportunities can give me, that return, while at the same time ensuring that I have adequate liquidity to meet for example, your needs as an investor. So the role of a fund manager is really to actually sit and think, this is the objective for which I've been given as far as this, the client, the investor is concerned. Where do I get the right assets to meet that objective? How do I layer those assets such that without taking too much risk, we are meeting the objective that the client has actually set, and then continuously managing that. Now, the process of managing that entails having, for example, having an investment committee that actually sets the overall risk, the risk parameters, that one wants to work with. Once the investment committee sets the overall risk parameters, the opportunity parameters that you can work with, then that hands over to actually what we call an investment manager. The investment manager is the person now responsible for saying, for this portfolio, this is how actually we're going to, concretize the investment process that is either laid out by the agreement with the client or the parameters that are laid out, by investment committee. Then after that, they take these transactions to the market, and taking that transaction to the market takes the role of an investment dealer. The investment dealer is actually the face of a fund manager as far as accessing market is concerned. So what the dealer does, they collate all these investment decisions by the investment managers and go and look for the right securities to actually purchase. And for a fixed income investor, those certainly will be, how much do I want to allocate, for example, to treasury bonds? How much do I want to allocate to fixed deposit? How much do I want to allocate to corporate bonds? How much do I want to allocate to these other potential investment opportunities? So as you can see, then the more there is diversity of potential investment opportunities, the more there is the likelihood that the investment manager is appointed or the fund manager is appointed will actually be able to meet their particular objectives. And that's probably how then the fund manager ensures that they are meeting the particular needs of their clients. But these fund managers certainly need to have a good level of the requisite skills to actually be able to do that. Now, there's a technical skill, of course, for the fixed income market is really what what Ivan was talking about. But beyond that, what other skills do I actually need to deliver on this opportunity? I need to be in a good way. I need to be a good negotiator because, for example, as a dealer, we take you to market every day, and you actually have to go and negotiate deals either through brokers or directly. For example, if, for example, I was placing in an unlisted security, which may be a case, then I need to be able to negotiate good enough to actually be able to get the best deal that I can actually deal. If I'm placing money in a bank, for example, then I need to make sure that as much as possible, I get the best kind of return that I can actually get. It needs to be a good networker. Networker here is because if there's a good place to actually get trading ideas come from dealers. Because these are the people who speak to everyone in the market. And their work is really to figure out what is this person doing, what is happening there, what is the psyche of the market, what opportunities can we actually see. And those are skills that will be very important even in ensuring that the market thrives even the more. Networking skills, developing trading ideas, and also have a very good knack for details. This is actually someone who can actually tell this is a bad deal just by looking at it. You know that people are that fast. They look at deals and say, this one, kill it. It doesn't make sense. And they will give you a very quick reason. And those are the capacities that will help even in ensuring that eventually when this market is rolled out, that you're actually milking as many opportunities as possible and avoiding risks that you are not willing to take. Because eventually you have to calibrate the kind of risk that you want to take and make sure that you actually live within that space. So that is what I was talking about earlier in terms of process, where the process starts. The investment committee sets the themes of investments. The investment manager takes over from there to actually decide how those themes reflect on the portfolios that they are managing. And then the dealers are sent to the market to actually look for, for the transactions. And then it is these dealers who then interact with the market. Now, how it works from a fund management business, they will face potentially what we call the sell side dealers. So as a fund manager, I've appointed someone to go and look for these deals for me. But to face the market, then they'll meet, say, brokers, all placement agents who they'll actually negotiate with. And then they can use those securities to actually complete the trading transactions. And within that, they also do a lot of risk management because they have to ensure that, all these trades are fully completed. The documentation is complete because I think we're talking about documentation much earlier to make sure that whatever could happen after that, that every party in the transaction is completed. And for the fixed income market, that could be a contract, that could be getting a contract, that could be, agreements, that could be making sure that settlement has happened and that everyone knows. And then they communicate with what you call the middle office to ensure that all the risks are always managed. So as you notice, I'm actually avoiding spending too much time on these slides because I'm very sure these slides will actually be, available for all of us to actually look at. Suffice to say, there are so many experiences that we actually get, from being in the market that can be of much benefit to this market. Just to highlight, I think what for me stands out is ensuring that over time you have one variety of issuers and a variety of investors. Variety of issuers will ensure that you have a good mix of assets. You come to Kenyan market, it's 99% government. If you're looking for listed securities, only a very small portion is a corporate issuers. What can you do to actually incentivize these people to actually really come to the market? That will be a very interesting conversation to look at. And eventually ensuring that over time liquidity actually grows. That makes the market the more suitable for would-be fund managers. So I think just to close it, I would say if I was sitting in this room and evaluating an opportunity, then there's a real opportunity here to actually set up a fund management business, a broking business, an issuer's business. There's a lot that you can actually do from this perspective. So even as you look at this evolving, then the question is, what role do I actually want to play? And I think there's a massive opportunity that we all should be positioned to take advantage of. So allow me to leave it at that. I know time is always never, on our side, but I truly hope that, that puts a bit of light as to what role fund managers are actually playing in this space. Thank you so much.